those workshops, and we'll be sending certificate to whoever completed the last three workshops. So I'll hand it to you, Mark, to start. Thank you.
Thank you very much. Hello, everybody. Good evening. Welcome to session 4. So as we just heard, we are 4/6 of the way through, or we will be by the end of the next hour and a half. We've just started what is the second part of this series of sessions. So the first part was at a more introductory level, more beginner level. The second part aims to move us to a slightly more complex level, slightly further up the learning curve. So we're going to start off today talking about volatility, and then in a week's time, next Wednesday, we're going to talk about option pricing, so how to get into the details of what we do mathematically. And then the final session is going to be our kind of free-form session where we have a little bit of insight from me, hopefully, on certain things to do with options, but also some questions from you and some answers from me. So it's going to be an ability then to ask any residual questions that have not been answered so far. So let's move through the materials. Just a recap, this is where we are in session 4. So this session is entitled Understanding Volatility. Now, last Wednesday, when we had a look at the component parts of an option price, we decided that there were 4 main price drivers of an option. There's the stock price, there's the strike price, and really it's the difference between those two things which affect the price of our option. And then there were 2 other things, which were volatility and time to expiry. Now, in the next session, we'll deal with all 4 of those price drivers. But for this session, we're just going to talk about volatility, because volatility is the price driver that makes options unique. Futures contracts, cash stocks, they are immune to volatility. Now, of course, volatility in the market will generate P&L for you, generate a profit or a loss if you take a position in a cash stock or a futures contract. But the price of those instruments themselves is not sensitive to volatility. But with options, we have a sensitivity to volatility. So it's important for us to understand exactly what it is, how we might measure it, how we might decide if the volatility that's being used to price an option in the market is fair, or if we think it's too high or too low. When we trade options, as we saw in session 2, we don't need to take a directional view on the market. We could trade the volatility of the market. And if you remember from session 2, we talked about straddles and strangles being the combinations that we would use to trade volatility. So during today's session, we'll understand what volatility is and how we would measure it. And then we could choose to trade these volatility products, straddles and strangles, to express a view on whether we think the future will be more or less volatile than the market is anticipating. Okay, so what are we going to learn? First of all, we'll talk about what volatility is as in a definition of it. What is it mathematically? And then we'll look at the difference between what we call historical volatility, which is volatility we've already experienced in the past, and then implied volatility, which is the number that we put into our option pricer. And implied volatility tells us what the expected volatility will be into the future. And then we're actually going to finish off just talking about something that might strike you as slightly unusual, something called the volatility smile and skew. And we'll do a little bit more work on this next week in session 4. But it's important to understand that there are complications to the way that we talk about volatility, and the smile and the skew are one of those complications. So we'll leave that till the end of this session, and then we'll try and cover it briefly at the end, but we'll also come back and cover it next week too in session 5. Okay, I think this session will probably last around about an hour to an hour and a quarter. So as usual, if you've got questions, then we're happy to take questions at the end. Please put any questions that you've got on the Zoom chat if you're in the Zoom room. If you're not, and you've been to previous sessions, if you're watching on YouTube, for example, and you've seen previous sessions, you will have seen the email address to send questions through to, and we'll have a look at that towards the end of this session again as well. Good. As usual, before we go on and talk about the content of this session, we had a question from the last session. So the last session finished talking about risk parameters in options and how we would use these risk parameters to predict our P&L and to predict how the price of the option that we've bought or sold changes through time. So I gave you a position here. So if we just have a look at this position at the top, you've gone short 100 contracts of a 3-month 100 put. So just to remember all of the details, the 100 bit here, that's the strike of the option. Put option, of course, is the right to sell. So this option gives me the right to sell at 100 in 3 months' time. Of course, 3 months is the expiry. Short 100 contracts. This is going to be equal to 10,000 shares because each contract is 100 shares and we've traded 100 contracts, so it's 100 hundreds. And then we're giving the following risk information. We have a delta of negative 0.48. Remember, put deltas are negative because a put increases in value with a decrease in the stock price. Our vega is 0.2, and that's positive because both calls and puts will go up in value as volatility goes up. And then we've got a theta, which is negative. This wastage of our time value, what we called theta or time decay, is costing us 0.02 units on the option price per day. So theta is conventionally quoted per day. And all of these risk measures are per share. So to get our position risk, the risk that we personally have, we'd need to multiply the risk metric per share by 100 to get one contract's worth, and then multiply that by 100 to get our position of 100 contracts. And then I said to you, I want you to have a think about what would happen if a week passes, so 7 days passes. The stock price moves up by 2 and volatility moves down by 3%. And so I want us to calculate what our approximate P&L is. So on the next slide, I've got the answer to this in numbers. But I just want to go through the intuition, what we're expecting here. So let's deal with the 3 component parts separately, individually. And let's start with delta first. So we're short a put option. So just from an on-expiry point of view, our payoff looks like this. Whoever's bought this put option from us is hoping the stock goes down. And therefore, we must be hoping the stock goes up. Because if the stock goes up, the put option finishes out of the money and we just collect the premium. So when the stock price goes up by 2, we should make a profit here. So when we calculate our position risk and then multiply it by this +2 move, I'm expecting to see us make money. We're also short an option and volatility is going to go down. Now, volatility brings down the value of all options. So if I'm short, then if volatility goes down, the price of the option that I've sold will go down, and that will make me money because I could buy it back now at a lower price. So this also should make a profit. Okay, so 2 things combined, those 2 things combined should make me money. Let's go and have a look at what happens on this next screen. Okay, so here we've got the answer to this question. So you can see that when I've calculated my risk position, and let's have a look at the delta for now. My overall risk position is acting like I'm long 4,800 shares. the stock has moved up by 2 units, and therefore that has generated 9,600 Rial of profit. And we would say that that is our P&L due to delta. If we have a look at our volatility position, our overall risk position here is that we are short Vega, so we are short volatility. And again, we've had a negative move, and so that is going to contribute another 6,000 Rial of profit. And we would talk about that as our P&L due to Vega. Now, apologies, I've just realized there's a small typo in this. So I'm going to have to make a correction to this. Time is actually +7 here, not -7. So apologies about that. That's going to change the sign of my outcome here. If I've sold an option at a certain price, and then time passes, if nothing else changes, the price will reduce because the time value remaining in the option, this value that we talked about last session, the kind of what if value, what could happen in the future if I just give the stock more time to move, that's just decreased by 7 days worth of time value. So as time passes, the option value goes down. I've sold the option, and therefore this is acting in my favor. So what I'm going to get, if I put +7 in here, then I would end up with a -200 position risk and actually a +1400 P&L due to theta. So actually all 3 of these characteristics is making me money. And I've added up the wrong numbers here. So actually this would be, just let me do this in my head. That would be 17,000 positive. Okay, for when these materials get sent out, I'll correct that. So you've got 3 different risk characteristics here, and the market has moved your way in all 3 of them. And it is very common with options to break out your P&L due to each risk parameter, and then your overall P&L is just the addition of all 3. This P&L will be approximate because none of these risk parameters stay constant. Your delta will change as the volatility moves, your Vega will change as time passes, your theta will change as the stock moves and volatility moves. So there's interactions between all of these 3 things. But over a reasonably short period of time and small movements in these market parameters, this approximate P&L should be relatively accurate. And certainly this is what every option trader does in terms of estimating their P&L on the move. Okay, so I'll just get that quick typo corrected, and then you'll receive the official materials with the right numbers in. Good, okay, moving on to volatility then. So volatility describes how much the market moves up and down. Is the market going to be nice and calm, or is the market going to be very choppy? And we need to develop a mathematical way of measuring this. And the way that we do it is that we lean on an assumption that the price of stocks is normally distributed. Now that's not exactly correct. You see, I've got market movements here are normally distributed. In practice, what we mean is that the returns on market price are normally distributed, and that's the percentage changes. So the probability of getting a plus or minus 1%, plus or minus 2%, plus or minus 5%, plus or minus 10% move, all of that will be normally distributed. So it'd be more probable to get small moves than it is to get big moves. And volatility in finance is measuring the standard deviation of this normal distribution. So when you're at school, I'm sure you studied some statistics, you'll have come across this concept of the normal distribution, this way of modeling outcomes in life, which occurs surprisingly often. If you were to measure the feet of everyone who'd watched this series of webinars, you would find that the length of everyone's feet is normally distributed. If you went down to Antarctica and measured the height of penguins, you'd find they were normally distributed. And lo and behold, when we look at how stock prices behave through time, we do find that these percentage changes are approximately normally distributed. So it makes sense to talk about a normally distributed stock price and measure how wide the distribution is. So the volatility is a standard deviation measure, and the standard deviation is measuring how wide or how narrow this distribution is. So on the left-hand side here, we've got an example of a low volatility stock. It's very probable that we'll get small moves away from where we are today. It's very low probability that we'll get big moves. And then we raise the volatility, we flatten out this distribution, we reduce the peak, we increase the width, and suddenly it becomes not enormously probable, but not zero probability to get reasonably large moves. Reasonably large moves that in a low volatility environment just could not happen mathematically. So that's what volatility is. So when you hear volatility, if you are statistically minded or mathematically minded, just think this is a measure of the standard deviation of the future distribution of stock prices. And I like to imagine it working like this. So I've done a couple of graphs here which show the impact on the price of a stock through time under a low and high volatility assumption. So on the left-hand side here, I've assumed a 5% volatility. And we talk about this a little bit later on, but this is an annual volatility. So think the stock can move 5% per year. And a high volatility is the stock can move 20% per year. So we always talk in annualized terms generally in finance, and volatility is no different. So we talk about the volatility per year. So a 5% volatility, you can see a stock starting at 100 doesn't really have the opportunity to move very far at all. We can see that almost every path here, and I've simulated 100 possible paths into the future, all of which are normally distributed in their finishing positions. You can see that it's really captured between about 90 and 110 in the stock price. However, have the same start at 100 and run in a 20% volatility world, and you can see a much bigger possible distribution of stock prices at the end. Also, the keen-eyed amongst you will notice that the spread of prices at the end is not symmetric around 100, and this is integral to our assumption of what's changing here. It's not the stock price itself which can move up or down with equal probability, so that we don't say the stock can move up or down 5 real with the same probability. What we do is we say it can move up or down X% with the same probability. So you imagine that a stock starts at 100 and then goes either down 10% or up 10%. If it goes up, it's now at 110, and if it goes down, it's now at 90. And then if you imagine what could happen next, if we say that it can still move plus or minus 10% of itself, then obviously if it's gone up, it can now move further in real terms for a 10% move. So a move of 10% is going to be plus or minus 11 real if the stock has previously moved up, and a movement of 10% is going to be plus or minus 9 real if the stock previously went down. So what you find is that paths that go down become quite compressed, and paths that go up can expand essentially up to infinity in the kind of mathematical limit. And what this does, this assumption, is it means that the stock price can never go negative. It's bound a lower bound of 0, because the closer we get to 0, the smaller and smaller the absolute movements in real are going to be for a given percentage change. So this is the way that we model stocks when it comes to pricing options. If anyone ever happens to look at the foreign exchange market as a trading opportunity, you'll find that options on foreign exchange are modeled in exactly the same way. If you look at options on interest rates, which is part of my past as a trader, interest rates can go negative and have gone negative in places like Japan and the Eurozone and Switzerland. And so we can't apply the same modeling technique in interest rates. We have to change things slightly to allow them to go negative. Anyway, we're in the simple world of stocks. Stock prices can't go negative. This kind of normal distribution assumption on the percentage changes works for stocks. Okay, so question for you. You're a trader and you bought a 3-month 100 call back when the stock was trading at 100. So this was an at-the-money call option with 3 months to expiry. 1 month has passed and it now has 2 months to expiry. And this is what the stock has done. So the stock is now trading at what looks like about 119. My question to you, and just have a think about this for the next 30 seconds or so, is do you now want high or low volatility for the next month? Do you want this stock to still be able to move in a wide cone of possibilities? Or do you want this stock to just trade sideways with a very low volatility? So have a think about that. And there is a correct answer to this. It's not subjective. There is a mathematically correct answer to this. And maybe after 30 seconds, if some people want to start putting some answers on the chat, I'll monitor the chat. So I'll just give you some time to have a think, and then we'll do a debrief in about a minute. Okay. Now, I've had one brave person on the chat who's volunteered an answer, and unfortunately, it's the wrong one. So the answer to this question is that you would want high volatility. And the reason I've asked this question is that this might sound counterintuitive. You might think, and I'm sure the person who answered this question thought this way, you might think, I just want the stock to freeze now. I've made money. I want to capture that money. And of course, if you own a single stock option on the Saudi exchange, you can capture this money if you want, because if you remember, the exercise style is American, which means that you can exercise at any point in time. So if you want to take your 19 real of payoff right now and cash in, you can just exercise your option and take the money. Equally, if you want to, you could sell the option back on the exchange. Maybe it's trading at 19.5 or 20 or something like that. And again, you take your cash out and you're done. Really, this question about whether I want volatility to be high or low in the future is the same as the question, which is, should I exercise now or not? Should I wait until expiry or should I exercise my option early? The two things actually mathematically are asking the same question. And so the reason that I want higher volatility, firstly, let's consider that when volatility goes up, the price of an option goes up, and it doesn't matter where the stock is. That will always be true. There is no point in the stock spectrum where the sign of that risk changes from positive to negative. So an option's price will always be increased, maybe by a small amount, but always increased if volatility goes up. So if the market thinks that the future will be more volatile and marks implied volatility higher, then you will make money in this situation because the price of your option will go up. And so the reasoning behind this is there is something we could do here instead of exercising our option or instead of selling our option. There is something we could do to lock in our gain and yet still be exposed to higher volatility. And what we could do is we could sell the stock. So let's say this has actually gone up to 120, just to keep the numbers nice and clear. If we sell the stock at 120, and let's say we've done one contract of this, so we're going to sell the stock in 100 shares. But we're not going to exercise our option. We're going to hold on to our option. We're now going to have a look at the outcomes of this new strategy as the stock moves. So I'm just going to move us to my notepad. And we're just going to draw out what's going to happen here. Okay, so let's remind ourselves the position is we're long a 100 call in 100 shares. And we're now short 100 shares at 120. Now, I should concede at this point, you would have to short sell these shares. So that possibility is maybe not open to everybody. An alternative, though, is that you could sell the futures contract instead of the cash stock. So there would be a route to doing this position regardless of where you are in the investor or trader spectrum. Okay, so if I do this combination, we're now going to imagine what might happen next. And bear in mind, let me just remind ourselves, what's the alternative? The alternative is exercise and make plus 20. Another alternative is hope for low vol and make approximately plus 20. If the stock doesn't move too much, we hover around this 120 level, we're going to make approximately plus 20 when we wait for another month to our expiry, or another 2 months rather. Okay, so let's have a look at what the outcomes would be on our new strategy, this holding on to our 100 call, but simultaneously selling the stock. So there are two things that could happen. Either the stock finishes above 100, or the stock finishes below 100. And these are the two outcomes that we care about. If the stock finishes above 100, everything is boring. Okay, I exercise my call, which means that I buy at 100, and then I've also sold at 120, so my net profit equals plus 20. And that's going to be true regardless of where this stock now finishes. It could go up to 150, it could finish down at 101. I will always net in the difference between having bought at 100 and then sold right now at 120. So the interesting scenario is what happens if the stock finishes down below the strike, below 100. So if the stock finishes down below the strike, I do not exercise. But I've sold at 120. So my net profit here is now actually going to be more than plus 20. And we can maybe better understand this with a graph. If I draw a graph here and we put plus 20 on the y-axis, if we finish above 120, then I buy at 100, sell at 120. But if we finish below 120, I've simply sold at 120 because my call option now disappears and expires worthless. So what I've got is I've got a situation where all of my alternatives were just going to lock in plus 20 today. But now I've got a position where I could make more than 20. I can never make less, but I could make more. But what do we need to happen here to win? What we need to happen is the stock, which is currently up at 120, we need it to move down a lot over the next 2 months. So that means we want high volatility. So eventually we've come round to the conclusion here. We want high vol because there is a strategy we could do right now that would make us even more money than all of the alternatives could lock in today. Now in practice, this is the kind of thing that certainly a sophisticated investor, let's say a portfolio manager at a hedge fund or a big pension fund or someone like that, or a trader at a bank, they could do this without thinking twice. They have an ability to go short the stock and borrow any stock that they need. They can sell futures contracts. If you're a retail trader, you're an individual trader, your ability to do this might be a little bit more limited, and therefore you might find Okay, let's go back to a bit of rigor around what volatility is. I've already mentioned that it's a standard deviation measure. I mentioned that it's an annual standard deviation. I've got a snapshot of my pricing model. Oops, apologies for that. Pricing model here, which is pricing up a call option. And you can see that it has a volatility of 20% that's gone into this price. And we'll have a little play around with this option pricing model in the next session on Wednesday when we talk about pricing in depth. Okay, so this volatility of 20% means that the 20% movement of the stock represents a 1 standard deviation move over a period of 1 year. Now, if you remember back to your maths at school, certainly if you went through the same sort of classes I went through when I was at school, you were told that there are certain probability rules around movements of X standard deviations. And a movement of 1 standard deviation away from the mean, and the mean is where the future of this stock is trading right now, a movement of 1 standard deviation should happen, a movement of, less than or equal to 1 standard deviation should happen with a 68% probability. So roughly 2/3 of the time, we're going to get a move less than or equal to 1 standard deviation. And then if we widen that range out a little bit and talk about a 2 standard deviation move, a movement of 2 standard deviations or less comes with about a 95% probability. So what we're really saying when we price this option with a vol of 20% is we're saying that there is a roughly 2/3 probability that the stock has moved less than plus or minus 20% over the next year. Now you can see that this gives you a tool that you can use to start to think about whether you think that this price for the option is high or low. Because what this price is saying is the stock could move by 20% up or down with a 2/3 probability. If you think never, that this stock is never going to move plus or minus 20% with a 2/3 probability, or strictly speaking, there's never a 1/3 probability that we move outside plus or minus 20%. Let's say you think that a move more than plus or minus 20% has a 0 probability. You actually think that the distribution that's being used to price this option is too wide. You think the volatility is too high, and therefore you think the option price is too high. Now that might lead you to sell this option if you think its price is too high. Or if you wanted to buy it, it might lead you to just not buy it. The distribution is too wide. The possible price movements baked into this option price are too big compared to what you think the market will actually experience. And really, if you're a directional trader, this boils down to your break-evens. A high volatility will give you a high price, will mean you need a big move to reach those break-evens, whether you buy a call or a put. And therefore, this is kind of the statistical version of just looking at a break-even and thinking, yeah, I'm not sure we finish above or below that point. If, however, you look at this and you think, yeah, I think there's a reasonable probability that this stock moves by more than 20%, then you might actually look at this volatility and think it's too low. Therefore, you look at the price and think it's too low, and you think, oh, cheap option. I was going to buy an option anyway to take a directional bet. This looks like the option to buy because it's being priced off a volatility that I think is attractively low. So option traders will take a view on whether they think that this volatility number is too high or too low. The important thing to understand at this point is the volatility that we're talking about here is the future volatility of this stock. It doesn't matter what it's done from the beginning of time up until the moment we buy it. It only matters what happens between now and expiry. So you can look at volatility and you can say, this is what the market is predicting as a volatility over the next 3 months, 1 month, 1 week, whatever the maturity of option you're trading is. And that means that we use a special word when we're talking about this volatility. We call it implied vol. And implied means that this is the implication that the market is implying that we'll have a 20% volatility between now and expiry. Okay, I've mentioned that vol is always quoted per year. If you want the volatility for a different period, either greater than 1 year or less than 1 year, then this is how we scale it. And this comes actually down to our statistical definition of volatility, it being a standard deviation measure. Standard deviation scales with the square root of time, and therefore we need to multiply by the square root of time here. So I've got an example in the table here. If we've got an annual volatility of 20%, that means that over 6 months, we have a volatility of 14.1% in absolute terms, all the way down to a daily volatility. Now, when I was an options trader, I paid close attention to the daily volatility because that was something I could understand a little bit more than 20% per year. You know, who knows what might happen over a year, and really it's it's almost too long a time span to think about what I can reasonably expect the stock to do. But it's interesting to think if you're buying an option with a 20% volatility, what that really means is that the stock has a 1 standard deviation move per day of 1.3%. So what this is saying is that the probability of moving less than or equal to 1.3% on any day equals 68% probability. So there's a 2/3 chance we move less than 1.3%, and there's a 1/3 chance that we move more than 1.3%. And again, you can view stocks trading day by day. You can have a look at their percentage moves and you can think, does that look reasonable? Does that look too high, too low? Is this something that I can use to form a trading opinion? Okay. So when we talk about volatility in markets, we could be meaning one of two things usually. And so we've already talked about implied volatility. That's the second meaning here. This is the number that we put into our option pricer to give us the price of the option. And what we're saying is this is how volatile the stock will be over the period until expiry. But historical volatility might be interesting to us as well. And that's how volatile this stock has been up to this point in history. It might be that we look back over the last month or the last 3 months, 6 months, 1 year, 5 years. We might look back through all the history we can get our hands on. And the reason that we might be interested in historical volatility is maybe we're trying to work out, is there a relationship between how volatile the stock has been in the past and how volatile it might be in the future? And so many options traders will analyze historical volatilities. In fact, some option trading tools will calculate an historical volatility for you and allow you to compare that to the implied volatility that's being used to price the option. So another question for you to have a think about now. If a stock has a high historical volatility, which of the following is definitely true? Not might be true or might be partially true. Which of the following is definitely true? And there is only one correct answer here. So have a look through A, B, C, and D and find me the one that is absolutely guaranteed to be true. And this is a slight trick question, so don't be surprised if you're tempted to say all of them are correct. Okay, so I'll give you 30 seconds to have a think, and then we'll go through the answer to this. Okay. We're going to discuss all 4 choices here, but let me just put you out of your misery. The correct answer is A. Let's deal with A first. A is talking about what's happened in the past. Now, if I have high historical volatility, that means this stock has moved up until this point, where this is today. If I look backwards, this stock has been volatile. This stock has a high volatility. So A is definitely correct. If there's only one correct answer and A is definitely correct, then B, C, and D have to be wrong. So the interesting thing now is to talk about why B, C, and D are wrong. And bear in mind here, wrong just means that they are not definitely true. They might be true, they might not. Okay, so let's deal with B. B, option prices will be very expensive. This all depends on whether the market thinks that the previous high historical volatility will be repeated in the future. Now, that's not necessarily the case. When you take out financial investments, you will often see, let's say you invest in a fund management company that's got a fund, I don't know, let's say an emerging market fund. And what they do is they show you the 5 years past performance. And normally on these adverts, when they show you that, it's because it's been good. So they might say over the last 5 years, this fund has gone up 12% per year, annually compounded. What they're really doing is saying you should buy into our fund because it does well. Somewhere on that advert usually is the statement that says past performance does not indicate future performance, as in we can't rely on what's happened in the past to be a good predictor of what will happen in the future. Now, we might think that the future is going to repeat the past, or we might not. There could be reasons why the stock has been volatile in the past, which no longer apply. Or we might reasonably think it's going to be equally volatile in the future. But until we know the context for this particular stock, we can't say for sure that option prices will definitely be expensive. The stock will be volatile in the future. Well, this is really just the same argument. It might, or it might not. It all depends on what's happened here. You could have got a stock which is a company which maybe is only 5 years old, and maybe they listed after the second year. So over the last 3 years, it's been quite volatile because the company's been finding its feet, settling down, making a profit, generally working out how to win market share, how to make money from whatever product it's selling. Once you get to a reasonable level of maturity as a company, then the profitability starts to stabilize and possibly the stock price starts to stabilize too. So if you're looking at a young company, it may reasonably be true that the price of the stock was more volatile in the past than it should be expected to be in the future. And there could be other contexts where this applies. D, will everybody want to own straddles? Remember, if you own straddles, you are long volatility. Well, they might. And really, one reason for analyzing the historical volatility is to try to decide for yourself what you expect to happen in the future. So people may have drawn the conclusion that this stock will be volatile in the future. I want to own a product which pays off in a high volatility environment. But there may be also people who are saying the past doesn't necessarily predict the future. Who knows how volatile this could be once everything settles down. Okay, so a it depends type question, but only A is guaranteed to be correct here. Okay, so just to reiterate, this is what we're talking about when we compare historical with implied volatility. And historical vol looks backwards, takes real data, and works out how volatile it's been. Implied volatility is our estimation of the future and really just sets the bounds within which we expect the stock to oscillate. This is how we would calculate historical volatility if you wanted to do it yourself. So you could go and get historical price data from any source that you find, Bloomberg or Refinitiv, if you pay for those sources. Free sources are available on the internet, of course, Yahoo Finance and the like. What you need is you need a time series of stock movements. And I tend to look at daily stock movements when I'm doing these calculations, but you could look more frequently, or you could look at weekly if you wanted to. A time series of movements, and then you need to calculate the daily return. Now, here's where I'm just going to drop in out of the blue a slight mathematical complication here. The change that we actually describe as being normally distributed is the change in the natural log of the stock. So if I go from time t to t plus 1 day, then the change in the stock's log is going to be the log of the price at t plus 1 minus the log of the price at time t. So that's a 1 day interval between t and t plus 1. And for those of you who remember logarithms from school, from maths in school, you'll know that that's the same as the log of s t plus 1 divided by the log of ST. And so when I show you a spreadsheet in a minute, you'll see that calculation being done. This, by the way, is very, very closely approximated by the percentage change in the stock price. So if you wanted to do that instead, just have a look at what the percentage change is every day, then this will actually give you an almost exact approximation. I did it both ways, by the way, in the example that we're going to see. And for the annual vol, it only changed it by 0.03%. So it's a small difference. I'm a mathematical purist, so I like to do it correctly. But if you want to do the approximate one with the percentage change, that's fine too. Okay, so what this will do is, because we're using daily prices here, this will give us a daily volatility. And then we need to scale that up to 1 year so we can compare it against the annual volatility that the market actually quotes. And we do that by multiplying by the square root of the number of days in a year. And strictly speaking, we use the business days in a year because markets tend to only move when the market's open. On good business days, they don't move, stock prices don't move at the weekend. And so we tend to multiply by something that looks like the square root of 250. Usually in most markets, there are approximately 250 business days in a year once you've taken weekends and public holidays out. Sometimes people use 252 here instead of 250. I've just used 250 because it's a more round number. So if you have a look at what we get here, this is what we get. And I'm going to show you the real underlying spreadsheet to this in a second. So I took, before we did this session, so I did this just a few hours ago, actually, had a look at a time series of Saudi Aramco. So Saudi Aramco on the 5th of December, so yesterday afternoon, closed at 33.05 Rial. And then what I've done is I've calculated, I've actually gone back 4 years down here. I've not shown you all of the numbers, of course, just the top 15 or so. And what I've done is I've calculated this daily log return. So the log of the stock on day 2 minus log of stock on day 1, the log of the stock on day 3 minus day 2, and so on. And then you can see I've used the formula text function in Excel here to show you what's happening inside these cells. So to calculate the daily volatility, I've used Excel's standard deviation function. So I've just said I want the standard deviation of this daily return price series, or this daily return series. So you can see price return series, standard deviation. And I've used the sample standard deviation here because I'll be looking at some subset of the full history of this stock. And then once I calculate that at 1.2%, I then scale it up to the annual figure by multiplying that daily volatility by the square root of 250. And so you can see what we've calculated here is historically, and I used 4 years worth of data here, Saudi Aramco has an annual volatility of 18.9%. Now, what you could do is you could go and have a look at where Aramco options are trading in the market. So if we look at where the implied vol is, let's say you saw that the implied vol was 25%. You might think, oh, that looks high. That looks high compared to where it's been in the past. Is there a reason why Aramco might be more volatile in the future than it's been in the past? Because if there isn't, that option looks expensive to me. Or you could go into the market and you could see that the market's trading with an implied vol of 15%. And again, you're going to make the same argument in your head. You're going to say, why is the market saying that the future will be less volatile than the past? Is there a specific reason for this? If there's not, then maybe this option looks cheap to me. So it's not always a good predictor of the future. But in the absence of anything else, historical volatility is measured and it is used as one of the ways that we could come to a conclusion about whether we think an option price is high or low or looks fair or so on. Let me show you the raw spreadsheet that underlies this, this screenshot, and I can just show you you know, these calculations really are happening. So you've got in column A here, I've got the dates from which I got this, closing price on each day. Daily return, if I just go into this, you can see here's my logarithm calculation. Log of B2 over B3 just takes adjacent stock prices and calculates the difference in the logs. If I go over to the daily vol, you can see that I'm selecting everything in column C and asking Excel to do me a standard deviation calculation. And then if we have a look at the annualized vol, you can see that I'm taking that daily vol and multiplying it by the square root of 250. Okay, so quite easy to do. And as I say, you'll probably find online tools or maybe even trading tools that you get access to that will automatically calculate the historical volatility for you if you find that interesting. So here's the trading indicator, the possible trading indicator. And again, we're always going to be thinking, is there a fundamental reason that there should be a difference? Now, we will come back to this actually in session 6, because I want to start by just thinking about the overall balance of supply and demand in the options market and whether we would be able to see any kind of price dislocation away from what we thought was fair based on the behavior of everyone in the market who buys and sells options. So I'll leave that until session 6 in 2 weeks. But we are going to come back and talk about these fundamental reasons for a difference between historical and implied vol. However, people will look at this and sometimes they might say, I'm going to use this as an indicator as to whether the option is overvalued or undervalued. And therefore, if I see historical volatility greater than implied volatility, and bear in mind, it's this that my option is priced off, then I might view this as a buying opportunity for options. Equally, if I see that historical volatility is low compared to implied volatility, then I might see this as a possible selling opportunity. I think premiums look high, therefore I want to sell the options and earn those high premiums. And sometimes, and this is the way when I was a trader at a bank, this is the way that I saw a lot of hedge fund traders using options. Sometimes a hedge fund trader would want to take a directional bet using an option. So they'd want to take the view that a stock went up or a stock went down. The decision as to whether they used options or not, or whether they just traded the underlying stock, often came down to what they thought about the price of the option as well. So if they thought options were cheap, then they might say, okay, I can express a view that the stock goes up by buying a call because I think call options are cheap. And I also think the stock goes up. So I'm expecting a double win, really. The option is presenting me potentially with the most economically attractive way of expressing this trade. If they look at options and see that they are expensive, then they might say, okay, I'll either, what I don't want to do now is buy the call. The break even is too high because the price, in my estimation, is too expensive. So I'm not going to buy the call, but I might instead ignore options and just buy the stock or just buy the futures contract. Or if I still want to express my view using options, I might look to sell an option instead of buy an option. Instead of buying a call because I think the stock goes up, why don't I sell a put? Sell what looks like an expensive put and then just collect the premium when I'm right and the stock goes up. So allying a view on the option price with a view on the underlying market is quite a common technique. Okay, so let's have you have another think. If historical volatility is very high compared to implieds, this is more of a subjective question, by the way. I want you to tell me which of the following trades might look attractive. So if you're minded to think that this is a good trading indicator, that if implied vol is low relative to historical vol, you think options look cheap. So you think options look cheap. Which of the following A, B, C, or D is going to look attractive to you? So I'll give you 30 seconds to have a think. and then we'll do the answer. Okay, so have a letter in your head, and I'll go through my answer. Now, as I say, this is a subjective question, as in there's not necessarily a right and wrong answer. So we'll just go through what I think. So you think options look cheap. Now, if you think options look cheap, you want to buy. So first of all, I'm going to cross out A, because that's selling options. I'm going to look at those straddles and think they're already priced too low, so why would I sell them at that price? If I look at B, then I think, yeah, I want to buy a straddle. I think all options are too cheap. I don't necessarily maybe have a directional view on the stock. I just think that the option is trading cheap, and therefore I want to buy calls and puts. So if I buy the at the money straddle, buy the call and the put, take myself into that V-shape payoff, that's an expression that I think the future will be more volatile than the market is suggesting in its pricing. Okay, so buying straddles, I would say definitely is a right answer to this if you think that the past will predict the future. So is buying a single call option, because that includes buying an option. I think options look cheap, so I'm going to be attracted to buying a call option. This is only going to work, though, if I think the option looks cheap and the stock goes up. So it's a directional view allied to a cheap option trade. So I think B and C are the correct answers here. I think you would not look at D. So if you remember ratio call spreads, this is where we buy 1 unit of a call and then we sell more than 1 unit of a high strike call. So a 1/5 is a very aggressive ratio call spread. And what that means is for every 1 unit of option I'm buying, I'm selling 5 units. So this is a net sell strategy when it comes to options. Now, if I think options are too cheap, I'm not going to be wanting to net sell them. I'm going to be wanting to buy them. So I would say that D is not correct. So either B or C is a correct answer, and both even more correct. This is how a trader might think if they view historical volatility as a good trading indicator. Okay, final bit in this session is to have a look at what we might see in real life when we have a look at option prices trading on the Saudi exchange. So often when you're looking at option screen, I've not had a chance to see a live pricing screen on the Saudi exchange yet, but I've seen many option trading screens that traders execute on. What they will normally show you alongside the price is the implied vol. So you can see that the implied volatility for calls and puts is being shown to us here. And my question on the right-hand side is, what do you notice about the volatility for each option? As we move up and down in terms of the strike, have a look at what happens to the volatility. The at the money, by the way, is our usual 100. So you can see that the at the money volatility is the 20% that we've been talking about for this session. But look at the volatility that's being applied for the lower strikes and the higher strikes. If we have a look at the 80 strike, you can see that both the call and the put are using a volatility of 35%. And if we look at the 125 high strike, you can see that the volatility is again higher than the at the money, but not quite as high as the low strike puts. This is indicative of something that we call the volatility smile, or sometimes volatility skew, or sometimes smile and skew. If we were to plot volatility versus strike, we would find it looks like this, with the at the money being down at the lowest point, our 80 strike puts being up at 35%, and our 125 strike calls being up here at 28%. And this is what we call smile and skew. And we can separate it into these two different parameters. And that example that we looked at before, that actually has a combination of both. So if I've got a volatility smile, what it means is that the out of the money options, I've drawn an exaggerated version here, the out of the money options are just higher in terms of volatility than the at the money options. But if it's a pure smile, it doesn't have a directional bias to it. So high strike calls and high strike puts both trade with a similarly high vol. Skew is when I have a bias towards puts or calls. And if we just go back one slide, you can see that I do have a skew here, because if I go down 20 in the stock, the vol has gone up by 15%. But if I go up 20, the vol has only gone up 5%. So you can see that there is a higher volatility being applied to the low strike puts compared to the high strike calls. There is an element of smiliness, but there is also a skew, which is tilting the market in favor of the puts. So I want to bring this session to a close now. We've run for an hour and 10 minutes, which means that there's plenty of time for questions if anyone has got any. I want to leave you, though, as I normally do, with a question to ponder for next time. But instead of it being a numerical question, I'm just going to leave you with a qualitative question, just a wordy question. I want you to think, what do you think causes traders to quote options with a vol smile or skew? Why would it be a situation where the at the money is down here and then the out of the money strikes trade at higher vols? And why would there be a difference between equally out of the money puts and calls? And it might be that you do a bit of research here, and a quick internet search on volatility, smile and skew will yield some answers, or it might be that you want to just puzzle this out for yourself. Just think, what could be going on here? And if you want, just put yourself in the mind of a trader, let's say a market maker who's making a price, and they've been asked for a price in the at the money option, and they've been asked for a price in, let's say, a low strike put or a high strike call. Why would they use a different volatility? And of course, the whole point of using a different volatility is to change the price of the option. And if I use a higher vol, I'm wanting to make it a higher price. You might think there's just one stock. If it moves with a certain volatility, it moves with a certain volatility. If that volatility is 20%, why am I using 35 in my option pricer for an 80 strike put? And so that's a good question. Why do you think the market is doing this? So I'll leave you to ponder that over the next week, and then we'll start session 5, debriefing this. Okay, so what's coming up in session 5 after the debrief of that question? We're going to deal with how we price options. So in session 3, we looked intuitively at what drives the price. In session 5, we're going to look at mathematically what's driving the price. And I don't want to scare anyone off here. We're not going to do any deep maths. This is not going to be degree level maths. This is going to be intuitive maths, the maths that a teenager could confidently cope with. So we'll just build up option pricing from scratch in a nice, gentle way. And we'll lead to a formula that we call Black-Scholes, which is the most popular formula used throughout the option trading world. And I'll talk you through just very gently through the moving parts of that formula just to see how it works. Unfortunately, this very, very popular pricing formula is wrong. It is slightly wrong. There are flaws in the assumptions that it makes over what the stock will do in the future. So we'll analyze what the flaws are. And we'll then talk about what the market does maybe to correct for them. And then, having just introduced the volatility, smile and skew, we'll talk about how we might trade that. Do we think the market is too smiley? Are those volatilities for out of the money options too high? If we think that, what should we do? Do we think that the skew for puts versus calls is too extreme? And if we do think that, what should we do in the market to express that view? So that's all coming up in session 5. You have the usual contact address, which we updated for session 3, and we'll now run with all the way through to the end. So if you've got any questions on anything we've covered, then please feel free to send them through to that email address. Just to reiterate what I've said in previous sessions, if you've got a big complex question and you email it through to this email address, we might cover that in session 6. If you've got a nice simple question that will be very quick to answer, then I would look to answer that at the start of the next session. So if you just sign in for the next session, hopefully you'll see your question getting answered. It's now an hour and 15 in, so it's coming up to 7:15 Saudi time. So you are free to go. This is the end of the session. But if you want to ask any questions, now is your time. So there's 15 minutes or so left for you to ask any questions. So please ask those on the Zoom chat, and I'll endeavor to answer anything you've got. But for now, thanks for listening, and we'll hopefully see you all in a week's time for a deeper dive into option pricing. So I'll just sit and await any questions. But other than that, have a very enjoyable evening, and I'll see you in a week's time.